Hi, and welcome back. Today, let's talk about situations where a transfer of a financial asset does not lead to derecognition. Sometimes, when an entity transfers a financial asset, it might retain significant risks and rewards associated with the asset. In such cases, the transfer doesn't qualify for derecognition. This means the entity continues to recognize the asset in full on its balance sheet. At the same time, any consideration received from the transfer is recorded as a financial liability. This setup has an ongoing impact. The entity will continue to account for income generated from the asset and also record any expenses related to the liability it has recognized. Essentially, the financial asset remains part of the entity's financials, and the obligation to repay the consideration received is treated as a separate liability. Let's consider an example. Imagine an entity transfers a financial asset but provides a guarantee to cover default losses on that asset. In this case, the guarantee means the entity has effectively retained most of the risks and rewards tied to the asset. Because of this, the asset remains fully recognized on the balance sheet, and the consideration received is recorded as a liability. The entity continues to manage the asset as if it were still its own, while also handling the financial obligations tied to the liability. This approach ensures that the financial statements accurately reflect the entity's ongoing exposure to the asset's risks and rewards, even though the asset has technically been transferred. That's all for now. Thanks for watching, and I'll see you next time.